This is a market update for January 2014, presented by Chicago City Estates. With the economy picking up and job rates increasing, more people now have the ability to buy real estate. Trulia predicts 2014 will be the year of the repeat homebuyer. Since home values have been increasing, many homeowners are finding that they have enough equity in their home to sell it and still have money to buy a different home, whether bigger, smaller, or the same size. This hasn't been the case in the last few years, when many homeowners owed more money on their mortgage than the market value of their home. With market values increasing, more homeowners can afford to sell their home and use the proceeds to pay off their mortgage, and in many cases, still have money in their pocket. Current homeowners aren't the only ones who are ready to move. There is pent-up demand in the millennial generation. Many people from this generation graduated college during one of the hardest job markets in history. As the economy improves, more of these graduates are saving enough money to move. The Urban Land Institute predicts almost 4.5 million new households will form over the next 3 years. Many of these are millennials who can now move out of their parents' home and support themselves, newlyweds and young families, and recent college grads who are starting their career. Many of these new households will not be ready to buy and will need to rent instead. Some might have the choice and will have to consider carefully which is the best option for them. What renters and potential renters should keep in mind is that the cost of renting is increasing. As Christopher Herbert, research director at the Joint Center, explains, if there is a surge in renters coming to the market and not enough housing for them, the price of rents will rise. In fact, Sean Donovan, the Secretary of Housing and Urban Development, says, "We are in the midst of the worst rental affordability crisis that this country has known." For anyone who is not sure if they should rent or buy, something to consider is the opportunity to build wealth through homeownership. The average net worth of a homeowner is $174,500, whereas the average net worth of a renter is only $5,100. However, interest rates have been rising. Currently, they are at about 1 percentage point higher than they were this time a year ago, and they are still rising. The interest rate that homeowners pay can drastically affect how expensive of a home they can buy. What is interesting about increasing interest rates is that many people believe that it causes prices to drop. However, looking at this graph, we can see that historically this has not been the case. Over the past 30 years, interest rates have dramatically increased 4 times, and in each of those times, real estate values increased too. What is affected when rates rise is affordability. This graph shows how one's monthly payments increase with higher interest rates. So if you're comfortable paying about $4,000 per month at today's rate of 4.5%, you should be able to purchase an $800,000 home. However, if rates increase by a whole point to 5.5%, you will only be able to afford a $720,000 home at about $4,000 per month. If you're still on the fence of whether it is more prudent for you to buy at this time, please consider the slide in our blog post below. It illustrates 5 financial reasons why buying might make sense.